Good morning. Happy Monday. Welcome to Forex.Today in a world of happiness and joy. I hope you don't mind me showering happiness and joy on you. It's the greatest day ever. This weekend was my birthday. Yeah, oh yeah, thank you. But I found out that I wasn't old as I thought I was. I'm 46, and they're like, no, you're 45. I'm like, what do you mean I'm 45? I was 45 last year. I'm 46 now. Last year was my 45th. They're like, no, last year you turned 44. And I'm like, really? I would remember that because like 44 is like a cool number. I was 45. And they're like, no, you just turned 45. I'm like, whoa, shit, really? Woohoo! I just gained a year. I'm a year younger today. Nice. How about that for a gift? Boom. This is what my daughter got me. A giant coffee mug that says, this coffee is making me awesome. Yeah, anyways. So happy 45. Again. So anyways, I just want someone to love me. Oh, 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 oh. Yeah. So anyways, yeah. You know the only other one time I decided to clean my office one time. I'm like, I got papers everywhere. I'm cleaning this and cleaning that. And I found a $10,000 check. I'm like, oh, snap, look at this. Went to the bank, cashed it. I'm like, holy crap. Yeah, I found $10,000. I guess I should cash that. Yeah. Or one time I got $110,000 tax return. Never had a tax return before. I'm an entrepreneur. All of a sudden I got $110,000 tax return, and then from the state of California, I got a $50,000 IOU. They actually sent me a letter like, we don't have your $50,000, Wayne. We owe you. I'm like, this is like the greatest ever. So whatever. So that doesn't buy you another year. So anyways, there you go. So welcome to Forex.Today. Super happy to be a currency trader. How about yous all? All you all? Yeah. Well, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. So please stay small, stay humble, focus on the long term, and never risk money cannot afford to lose. Yeah. Does anyone else have the joy of paying like estimated taxes? The joy of being an entrepreneur in the United States of America? Yeah. Guy has something similar in Canada. What does that end up being, Guy? Certainly 50%, huh? Forex is tax-free in the UK. I thought it was spread betting that was free, tax-free in the UK, Barry. Anyways, John's got 3 companies. Trading Forex and trading futures and trading physical. And it was commodities. I remember one year I traded. I traded the stock market. I traded stock indices. I traded commodity futures. And I traded Forex all in the same year, and they all got different tax treatments. And my tax return was, I'm not joking, we started in February, it was done in November, and it was like the size of a phone book. I'm like, what the F is this? And they're like, by the way, it's $15,000 to submit your tax return. I'm like, just doing the work. I'm like, what? And they're like, yeah, everything was taxed differently. So that day I just said, you know what? I'm trading Forex and the correlation of these intermarkets all through Forex. So if I want to trade oil, I'm trading oil through Forex. I'm just buy the CAD, right? That kind of stuff. And then, CFDs and futures contracts are like 2. But if you can trade it through all one, then, that's all good. But then trading all these other markets and getting tax treatments and all these different rules, I don't need to employ so many tax attorneys, bookkeepers, tax preparers, and all that kind of stuff. So anyways. Yeah, Anthony's like, yeah, definitely not tax free. Yeah, it's the spread betting that's tax free, I thought. But anyways. Yeah, yeah, see, it's not free in the UK, as Mike says. It's actually under Schedule E. Yeah. So anyways, it's spread betting though, but whatever. Well, Barry, that's funny because I don't know who you're talking about, but I don't live in the UK, but even I know that. All right. So let's, oh, hey, by the way, my name is Wayne McDonell. I am the Chief FX Market Strategist for TradersWay.com. Thank you very much for being a client. We work hard to be invisible. And that's kind of what you want from your broker. When you click the button, you want your trade to execute quickly. You want your spreads to be competitive, and you want everyone out of the way. And you want your trade to actually be executed into the interbanking system. You don't want someone trading against you. And if anything does go wrong, or if you need assistance, you would like some world-class customer service that treats you like a human being, right? These are the high levels, the high threshold that you can't get from other places. We can certainly meet those expectations. In fact, I love you. You're my sweet baby, and I want you to succeed and thrive on the long term. Isn't that nice? I think it's the right business model. If you succeed on the long term, we succeed on the long term. That's called a business partnership. So I'll tell you what, I'll be here every day to help you learn Forex. I'll be here every day to help you develop the skills necessary for you to make important investing and trading decisions on your own, with your own analysis. Right? Jacques says, quite impressed with your MP4 platform so far. Right on. Cool. So anyways, good. Big one, happy family. I hope you enjoyed Trading on Farm Payrolls Live 145 that we did on Friday. Sorry to the swing trading group. I did the video session, but I did it quite late. Apologize. Friday got complicated. I sent out the invitations quite late. I did do them. They're up there, but I apologize for that. But the event, the FX Street event, was quite popular, well attended. So that was cool. And here we are Monday to clean up the mess. Not ex ante, that's before NFP. What's after NFP? Ex post? Ex post NFP? Does anyone know their Latin? It's ex post, right? Anyways. Yeah, Charles, like, yeah. And you know, I kind of thought, like, I tried, here's the thing. I kind of told myself I want to bang that out in a half an hour because, you know, I don't spend a half an hour setting my swing trades for the week. Half an hour, right? So I'm like, I should be able to bang this out in a half an hour. I think I did in 31 minutes because I babbled in a bit, right? So anyways, that's how it should be. But I kind of feel like I want to do, so I won't do them all that way, but so whatever. USD CAD, let's start here. And before we go, what are the things going on in the world? The things going on in the world, non-farm payrolls was a mixed bag. What the Fed cares about is wage growth. What we don't really care too much about is the headline number because we know what the trend is. We'd like to see unemployment dipping probably below this 4% threshold. But to get there, we're going to have to suck the people that are not into the workforce. So if you break down the workforce, you have in the labor force and not in the labor force, which is the non-participation rate, and then And then there's the unemployed. Okay, so employed, unemployed, not in the workforce. And we want to see that workforce participation rate grow. All these people that could have jobs don't have jobs. They're not looking for jobs, right? So at some point, what we'd like to see is those people come back to the workforce, but then that raises the unemployment rate, and then we got to dip it back down. And then at some point, there's no one on the sidelines anymore. The labor force participation rate would be very, very high. The not in the labor force number would be very, very low. But as that number lows, the unemployment should go back up. And then if that goes back down and there's no one else on the sidelines, at some point, employers are going to have to raise their wages to attract someone, right, to work for them. So I like to think of driving down a street in an industrial part of town, and there's like warehouse here, warehouse there, warehouse there, warehouse there. Everywhere there's a warehouse. So how do they compete if there's only so many warehouse workers, and you need to like double your or increase your labor force? The only thing you can do is go across the street at lunchtime and say, hey, dude, why don't you come work at our factory? This factory sucks. It smells bad in here. Do you really work in such a place? By the way, if you work for my factory, I'd buy you lunch. You see what I mean? Make sense? We want to see that. When that happens, then the Fed really wants to raise interest rates. Okay? We're not quite there, and you saw that in the non-farm payrolls where there was a shift in that not in the labor force, the participation rate, kind of more people came in and unemployment went there, but jobs were fine, and then there were revisions and all of this gobbledygook, not quite at there, but that's coming. That's going to happen, right? That's the theory. The mystery right now is why don't we have higher inflation, and why is productivity low, really? I mean, we have high productivity. We're just not measuring it properly, but these are the things that the economists are thinking about anyways. What else is going on? 10-year T-notes still sitting around 3%, 2.95 like for the whole week. Remember, we were talking about if it collapses, it may mean one thing, and if it rises above 3%, another thing. Well, it hasn't collapsed, but it does feel like foreigners are buying and locking at the 3%, right? How can we tell that? The dollar is strong. So that is an assumption that we can make that the United States government is issuing a lot of treasuries. Lots of treasuries. They're just flooding the market with treasuries. They're borrowing money like crazy. It seems that foreigners are lining up. And one of the reasons is Europe is not doing, and so this is yet another bullet point right now. The data out of Europe has been disappointing for about 5 or 6 weeks. Before then, it was actually surprisingly good. It looked like Draghi got himself out of a tough mess. And then it wasn't so good anymore. So we've gone through this 5-week period of like, why would I buy a 10-year German Bund for 0.67%? 0.67% when I can buy a 10-year treasury, 10-year T-note that pays 2.95. What, right? So right now that seems to be the game, so to speak. But I'm wondering, is it really the yield differential? I mean, why not? There's some hot money flows, is what you can call it. But I'm wondering if over the next 6 months, I really need to roll up my sleeves and examine whether the macroeconomics are as good as I thought they were. It's a timing issue, right? Yeah, yield only tells part of the story. And then there's this issue of like normalization. When will the Fed want to slow things down? All that kind of stuff. Is there some seasonality to this? Is another question. Okay. But now the next bullet point, I think we're on like bullet point 6. Oil prices went up. Well, that's what we've been talking about for how long now? How long has the Wainster said oil prices were going to go up? Like forever, forever, right? That is going to create inflation. There's your inflation, guys. That's it. Everything in the United States of America has crude oil in it. From the food you eat, to the clothes you wear, to everything. The cars you drive, planes you fly. Like, what doesn't have oil in it? Right? Most people are shocked to find out that farmers don't fertilize their field with cow or horse manure. I think a lot of people really think that that still happens. Fertilizer is actually cracked from natural gas. It's a petroleum product. That's where the phosphorus and such comes from, the nitrogen and all that kind of stuff that you put into the ground. That's a crude oil product. Well, nat gas, which is a byproduct of the crude. Okay. Jean says the world loves Trump. You're crazy. I like you, John. You're crazy. All right. Yeah. All right. So, was that an okay kind of wrap up? That's what people are thinking about: crude oil, treasury, wages, all that kind of stuff. Now, that's going to affect interest rates. Higher wages, higher interest rates. Higher crude oil, higher interest rates. Higher interest rates, higher dollar. I don't necessarily like or want that. Okay? So let me add one more level of complexity to this. If we can get the whole world on board, because that's all a U.S. story, right? So if you isolate the United States of America by having the Mexicans and the Canadians build walls, that's what's going to happen. You actually get inflation. The model we need, though, is global, and we need to see import-export data. We also need to see like money flow coming in for treasuries and going out for treasuries. And we want to see the rest of the world doing business with the rest of the world, not just with the United States of America. So if we can save Europe, and remember, 5 or 6 or 7 or 8 years ago, I was saying that China should bail out Europe. The United States was doing quantitative easing. The stupid social pig dogs in Europe were doing austerity. They're like, austerity? How could that possibly work? We will spend less money, we will tax people, and drive our economies into the ground. And then Draghi followed up with, I think we should do less for longer. You're like, socialist pig dog Europeans, right? You're like, wow. So the world kind of, there was this point where like the United States drank the bitter medicine and fixed itself really quick, but that's the American way. And did just like quantitative easing. We're just going to spend our way out of this. And that particularly works when you are a reserve currency, right? But what China should have done is bailed out Europe. Bailed them out. Like literally bailed them out. Instead of spending $1 trillion on the Chinese economy, they should have spent $1 trillion on the European economy. Just give them the cash. Save Europe, and then now the global economy is back, and then that saves China, and then China saves Australia, New Zealand, and Canada, and so on and so forth. And then there's Argentina. Is that even savable? I don't know if you caught this. Argentina, and this is a fact, raised interest rates on Friday to 40%. 40, not 4. 40. Yeah. You like them? How do you like them pesos? Oh. Wow, that sounds healthy, huh? Hey, it's only been 80 years. So if you go back 80 years ago, guys, Argentina was in the top 10 most productive per capita productivity, right? In the world. It was like Canada. Literally. You had the United States, right? If you broke it all the way down, and somewhere Canada was probably top 4 or 5. And then, you had Argentina, huge producer of wheat, for example, and other commodities, massive, right? Remember, Buenos Aires is the Paris of South America. It was the center of culture and class. Think of people playing polo and drinking their Malbec, and right? And then socialism came along and screwed it up, and it's still screwed up, and it's still paying the price. You're like, wow. So, anyways, you see I'm opinionated. You have to be. You have to be. You have to be opinionated. So, anyways, quite a carry trade. Yeah, but you're going to face some risks, right? Yeah. Okay. All right. So let's move on.com. So oil is at $70. We've been talking about this for a very long time. Correct me if I'm wrong, but we had that, I think, as last week's actual target, wasn't it? $70.29. Oh, I'm sorry, it went to $70.37. I was 8 cents off, and a couple of hours off. Sorry. So anyways, we're at 70. Excuse me. We're at 70. What an amazing world we're in, huh? We're at 70. Does this mean there's demand from around the world? Remember, I said the world doing business with the United States, but the world doing business with the rest of the world? Okay? That's important. Or is there a supply problem here? Well, supplies are supposed to be going up this time of year until June 1st. We talked about this a week or two ago. Well, maybe that can be off. We can be off a couple of weeks. So one of the things you could do to answer that is look at the oil inventory data that's released every week. Okay. FLE says, what's the likelihood of stagflation? We're not even remotely close to that. So the likelihood, well, it's so far off that talking about it now would be silly. Okay, stagflation, we're growing like crazy. Okay, and inflation, we don't have any, right? Unless you're talking about Argentina. So yeah, I mean, if you're talking about Argentina, low growth, high inflation, yeah. But see, that's because their monetary policy being pegged or were pegged, or they're in a complicated situation. They need, but whatever. So let's go back to this. It seems to me that we are drawing down inventories early in the cycle. So again, June 1st is typically my day where I switch from an inventory bull, which means a lower or flat oil prices. And then June to December is typically when you start drawing down inventories. Now, that I did 50 years worth of research, so clearly you can be a few weeks early, a few weeks late, and there's a big sort of window. So maybe that window's early. There's also other things going on, right? So like the Iran deal. Okay, the Iran deal maybe cut some supply off. Right? What happens then? Right? If the oil from Iran gets taken out of the market and stuff. So interesting. So we have to decide if prices are up in oil because demand is good. Typically, you want like a weak yen, a weak dollar. If you believe it's a supply side shock, that's bad, and you would expect a strong yen and a strong dollar and higher crude prices, which is a whole different thing. Okay, what's the right answer? I don't know. Do your research. Look it up. Right? What did I say last week? If you're interested in that, EIA, IEA, OPEC. Those are 3 places you can start now on research. Okay. Cool. So $71 and then $73 is the next levels. Okay. So 71 conservative, 73 potentially. Okay. All right. So right now we're in a strong dollar world. I think a lot of this is central banks talking down their currencies. I think a lot of this is the high interest rate, right? Sitting at 3.0. And until things change, that will continue. Very dramatic breakout here. And not necessarily the direction I wanted personally. Okay. So that's that. So you can see if you trade like a portfolio manager, when you're right, you're going to do very well. When you're wrong, you're not going to do very much. And I like that. You have a lot of time to do research and become an expert of your domain. So right now, dollar bears are doing their job, which means doing not a lot of things. So what would a dollar bear do? What would a bull do on the euro dollar? Well, last week we had, if you look way left, we were at a very obvious level of support. There was stuff going on here. We had Let me try to close this a little bit. Okay, we had daily 200 EMA. We had a monthly pivot. We had weekly target zone. So do you think it was fair to have a trade plan where this might go up? Pivot, target zone, support, and yet it's still not enough. It came up, it hit 120, and if you were a bear, I'm sure you would have sold 120. Well, I guess it's not quite 120, but right in there. I mean, that, right? It opened for what? Just long enough for London to come in and boom. Okay. You were short dollar at 60. Well, Barry, your stop was 15 pips. You threw away a 100 pip profit for 15 pips. Am I reading that correct? 1960, stopped out at 1975. Okay. Anyways, you have to really stop and ask yourself, okay, I'm not picking on you, Barry, but you really should stop and say, why didn't you make 100 pips? Or in this, you know, we're 50 pips into it. We can do it that way. But what, you know, why, right? Why are you not in this? And it's a legitimate question. Like you can see, I have a target here that we created, I don't know, a couple of weeks ago, right? A couple of weeks ago, our target on this was, you know, as low as 18, basically 1850. So if you're selling at 1960, you know, why are you not in it? 150 stop loss, the target was 19. So I don't get it. I was short at 1960 and you got knocked out at 1975. Right? So you must have moved stop or something. Anyways, our goal, guys, is to stay in these trades. If you have a longer term trend, which looks like Barry did, if you're trading your bias and stuff, your goal is to stay into the trade as long as possible. Oh, well, there you go. That, oh, gee, you're right. Because of the fractional pricing, you're moving your stop 150 pips. No. It's 15 pips. You're not calculating the fractional pricing properly. Yeah, it's not 150 pips. It's yeah. Yeah. So like I guess I can. Well, I'm gonna do it this way. Okay. You see that? That's not 2,000 pips. That's 200 pips. Not 2,047. That's 204.7. Okay. So anyways, all right. Yeah, because I think if you'd manually do it and on a trade and stuff, you put in 150, but it should be 1,500. Anyways, but clearly it wasn't 150. So anyways, let me go back to the psychology thing because you know we could all figure this out, right? Okay, this is fine. You want to stay in the trade. That's what I'm trying to get at. Okay? And in particular, I'm trying to get a lot of you guys away from scalping as a primary strategy. You can scalp all you want, and picking up easy pips is picking up easy pips. It's fine, but it's not going to lead you to the goal that you have for yourself. Now you're like, Wayne, you don't know me. You don't know my goals, right? Like, whoa, 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 settle down, dog. I do know you. I know you don't want to work day and night for the rest of your life. Otherwise, you'd be a coal miner or something, right? That's hard work. Sitting there, chip, 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 right? Up, down, turn around, pick a bale of cotton. Up, down, turn around, pick real day. Like nobody says, I want to pick cotton for a living. I want to go out to the field all day, every day, and I'm going to get paid by how much cotton I pick. I'm going to sit in front of my charts for 18 hours a day and make a trade, 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 and make a trade. And then I go on vacation and like, you're not getting paid. See, it's income versus wealth. I have no problems picking up like 150 bucks because it's sitting there and you're like, well, I'm going to scalp that and pick up 150 bucks. I'm all with you on that. But to have it as a primary strategy is not the right thing in the long run because you're just going to get old and fat and your eyes are going to go bad and you're going to get a bad back. You want to get personal here? Because I have all those things. I got old. My eyes are going, right, from staring at the charts. I got a little bit robust around here. I have actually sat and traded for so long, just in front of my charts trading, one trading session. I've actually traded for so long, I wore the skin off my tailbone. Because I traded for 2 or 3 days with straight, just covered in sweat and stink and stench and food and cups all over my desk and my eyes are all shot and I'm just trading and trading and trading. It's not a joke. I literally wore the skin off my tailbone. All of a sudden I'm like, ooh, what? Oh, I couldn't sit. It's a true story. What does it mean to you? What does it all mean, Basil? It means you cannot trade like that forever. Okay? You cannot trade it forever. And even if you do, let me tell you, it's not the way to get the filthy, stinking rich and drive the yellow Lambo and all that kind of stuff. By the way, my portfolio manager group, I think what I want to do is I want everyone to be so successful that we buy a Lamborghini, a yellow Lamborghini, a Gallardo, and donate it to charity. I think that's like now a personal goal of mine. I'd like that group to do so well, we just go out, buy a Gallardo, and just give it away to a charity group so they can auction it and get publicity and get the money and all that kind of stuff. And like, there you go. So how are you going to do that? Scalp, 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 scalp. What we need is I wouldn't give away a Huracan. Are you joking? But a Gallardo. Dude, my friend has a 3-year-old son. And he knows cars. This kid knows cars. He can go by and he can say, that's a Camaro, that's a Corvette, that's a Huracan, that's a LaFerrari, right? And then you ask the kid, and what about that? And he's like, it's a Gallardo. I don't like Gallardos. It's in Africa. Yeah. Nah. If you're in Africa, you're going to drive like a California. You're like, it's not even a Ferrari. California, why don't you just buy a Corvette and save yourself $100,000? Gee whiz. I'm sure a Corvette would blow the doors off of a California. Cali. Anyways, so you got to be in the trend. You have to learn this. You really do. You can scalp all you want. I love scalping. You can swing trade all you want. I love swing trading. You can spot trade all you want. That makes sense. It's, you know, that should be sort of your bread and butter. Okay? But where you want to be 10 years from now is pretty gosh darn good at all of it. All of it. You want to be healthy and robust in your trading skill and knowledge. Okay? Including fundamental analysis. So like when you talk oil, no, I don't want an opinion per se. When you talk oil, I want you quoting the EIA, the IEA, and OPEC. And then throw in, who should you throw in? Hey, did you read that World Bank report that came out? Right, just throw in the World Bank. Like, wow, I was looking at both the World Bank report and sort of a combination of OPEC and IEA, and you can see how they come together and totally corroborate my point of view on oil. Blah, 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 right? That's kind of where we want. Yeah, I didn't like it at all. Here's the thing. I don't like stories about scumbags. I just never did. You know, so selling penny stocks, you know, I like people that are heroic in positive ways. You know, like you measure someone's strength by how kind they are to other people. To me, that's a real hero. Are you strong enough to be kind? Right? Some scumbag selling penny stocks because they're unregulated and strippers and strippers and cocaine and like it's so boring. Yeah, every day. You know what a hero is? The guy that owns the restaurant that gets up at 4 o'clock in the morning to buy the food, and he's still cleaning the kitchen at 2 o'clock in the morning. The farmer in his field is a hero. I mean, that is hard. Vacation time, heroics. When does he get his award? Right? My Uncle Bill, who just recently passed away, was so close to me, I named my son after him. You could call this guy at 2 o'clock in the morning on Christmas, and he'd go out to a field that's frozen, no joke, minus 40 Celsius, negative 40 Celsius. And he would lay under the pipe and weld the pipe, no problem. That's the movie I want to see. Wolf of Wall Street? Who cares? Pathetic little child. But anyways, I'm a bit opinionated. And I've always kind of been that way. I used to get so mad, like maybe it's one of the reasons why I left the Silicon Valley, but I used to drive down the street, and I remember one particular time in one particular neighborhood, I don't know even why I was there, but I'm driving down this street, and there's beautiful house after beautiful house after beautiful house. And it was either my wife or someone else in the car said something, and I got so mad. And I'm like, these scumbags stole from teachers because they were lying about their BS internet stocks, and the venture capitalists that own that beautiful house behind the beautiful gate also owned the magazines that were promoting how heroic their startup CEO was, which was some idiot bumbling nonsense. And that stupid company with $100 million in VC money bought crap from another stupid company with $100 million of that, some other venture capitalist money. And all this money went around in circles and around in circles. All these stupid companies that shouldn't even be alive buying crap from the other company that had too much money, that bought crap from the company that had too much money, and just went in the circle, went IPO, and then they sucked money out of pension funds from the California Teachers Association and stuff, and then dogfood.com goes public, and then a year later goes bankrupt, and it was all because it was hyped, and that guy lives in a mansion, and what did the teacher get? You know, and I'm like, ah. So don't get me started. Wolf of Wall Street. I like people that work hard and get their job done. I want you to be the hero that simply trades and puts their family in a better situation. That's the movie I want to see. Anyways. All right, so you got to be in your trades, guys. You got to stay in your trades. So whoever sold it up here and got knocked out, no, man, no way, Jose. We got to try to be in there. And remember, this situation, it opened up outside the pivot, so it's not a good weekly pivot. It's even opened up outside the monthly, so it's not a good monthly pivot. We do know the target. We do know you're supposed to be using moving averages. I hope you know all of this. Okay? Okay? I want you to be in that trade. And if you got knocked out because you threw down 150, but you forgot about the fractional pricing, so you thought it was 150. See, 150 would have been fine because you would have been way up here. I would rather you have true 150 pip stops if you're going for 150 to 300, which would be a typical, 300 is a lot for a weekly scalp, but 150 or more would be a fine weekly stop. It's a bit much with this because it really shows you logically there's only about 100 pips in it. But I want you to right size that stop so you're in. So a lot of newer traders, their stops are so close because they're afraid of losing, or they're over leveraged and they have too much money on the line. They're like, Wayne, I got my stop 15 pips away because it's 150 bucks and that's like 40% of my account. Wow, that's your problem. Okay, your account side is way too large, right? The other side is, well, Wayne, I don't want to lose. Well, what's wrong with losing? Well, I took a course from some, socially deviant moron, and he said, he has 80% winners, and I should be like him. Well, that's stupid. You shouldn't want 80 or 90% winners. It's just stupid. First of all, no one's going to invest in you, because what do you actually tell a potential investor if you have 80 or 90% wins? That you don't know how to take a loss. You want to show someone, I know how, when I'm wrong, I get out quick. When I'm wrong, I'm out and risk is removed. So in my book, which is actually right there, I actually said take pride in your losses. You should go up to someone. I love losses. I love taking my losses. They don't happen that much, all right? But when I'm wrong, I'm wrong. What's the first thing you should do when you meet a potential investor for your Forex fund? Let me show you losses. Let's dive right into it. Let me show you my worst months. Do you think that that's what the investor is thinking you're going to do? Do you think that's what the investor's thinking? I mean, what's the investor worried about? Well, if I give this dude $1 million, he's going to blow up the account, right? So you're going to go in there like, I'm the world's greatest trader. I never take losses, right? And he's going to think, you know what? I don't believe this guy. I don't believe this guy. This guy's lied to me. And then all of a sudden you come up and you're like, hey, let's go through my 3 worst months. And let me tell you why it happened. why it's not likely to happen in the future, right? So that's where you should get. You should, when you lose, when you have a losing trade, you should be wrong. You shouldn't get unlucky. Like John, somebody, it was John M, and then a different John, or sorry, John keeps changing his name, so I don't know if it was John Andrew. But a couple of weeks ago, like John was saying, like he was going through a tough time. Was that you, J.A., John Andrew now? That going through, it was a tough time because his trades were correct, but he was losing money. Right? And I'm like, oh, that's the worst sin ever. You're right. You should be getting paid and you're losing. Well, so what's the issue? Well, you're getting knocked out of volatility. And so we need to change that. And when you get knocked out, you should be wrong. You should not get knocked out and be right. So how do we do that? Well, right? If your stop was 10 times bigger, whatever that is, if your stop was 300 pips away on a trade, do you have to be significantly wrong in your analysis to get knocked out, to lose the 300 pips? Or just simply unlucky? You're like, whoa, what happened? What was that? Polish PMI came out, knocked me out. You should be so wrong, like you're catastrophically wrong in your analysis, right? Now, most people are wrong because they have no analysis. But what if you're like a bear selling at resistance, right? To be wrong now, let's put it this way. To be wrong, your stop should be like up here, right? Like you should be so wrong that it's unlikely that you'll get knocked out. So how do you do that? Well, now you have to have a wider stop, but we don't want additional risk, so lower your lot size. And when you're wrong, be very, very wrong. But don't be like this guy that's sitting on a trade and he's negative 100 or negative 200 or negative 300 or negative 500 or negative 700 because he can't take a loss. But don't get chopped out on volatility. Okay? So you got to get your lot size correctly to your account size and then figure out the quality of your trades. Are you getting knocked out with 15 pip stops? Well, what about 30? Well, what about 50? Where's your sweet spot? Will you do better if your stop is 50 pips away? And start measuring these things. Ellsworth, the smallest lot size you could possibly get. If you can get a micro, if 100 pips could be worth a penny, that's what you should do. Well, okay, seems small. Well, how are you going to get filthy, stinking rich with no money? Right? Let's just talk about it. Don't get it right, and don't get emotional on me and stuff. Okay? Yeah, I know. Yeah. You just started. Great. So let's put it this way: if you just started, you should admit to yourself you suck. And I'm not picking on you. That's what I said to myself. I just started. I suck by definition. So I'm like, well, you know, right? If it were me, I'd say, I don't have enough money to get rich because $1,000 for some people is a bottle of wine, not an investment vehicle, right? And then what? I don't have any skills or knowledge. I don't know what I'm doing. So how can I pause, right? So I'd say, by definition, I suck, and I'm underfunded. Okay? So, Ellsworth, do you have a rich uncle? Someone that could drop 50 grand, 100 grand, 500 grand, maybe just slip you a mill to get you going? Like, I don't even have an uncle, right? No. And most people don't. Good. So we got this established. So you don't have you're undercapitalized. Even if you wanted to start a restaurant, you're asking me like, well, what kind of restaurant can I start with $1,000? Well, a small one, right? A small one, the smallest one you can think of. All right. So again, I'm not picking on you. Just right. Just these are facts, right? So the one thing you can work on now, Ellsworth, right? The thing you can work on now is improving the skill so that you don't suck. And then if you can get to a point where you can prove to another human being that does have money, that doesn't know you. See, if right? If you had a rich uncle, they're like, Ellsworth, right? Ellsworth, you're a good guy. I like you. I know you're going far. I know your work ethic. Your blood too. It's all family. Let me help you out. I actually had an uncle that said something to that effect. I remember we were in Connecticut, and we were out racing at the Rolex Vintage Series. We're sitting at, oh yeah, we're at the house. Do you guys know New Yankee Candles? These are shops all over the United States where women go to buy like $30, $40 candles. Do you know these candles? We were at that dude's house in Connecticut. And anyways, I was having this nice moment with my uncle, and I'm sitting on the side of the hill, and my uncle says to me, you know, I'd like to give you, I think he said like $100,000. I'd like to give you $100,000 to trade Forex with. And I'm like, no, no, thank you. So it always helps, right? It always helps. But you got to get now to the point, Ellsworth, you got to get to the point where another human being that doesn't know you, doesn't know your work ethic, doesn't know anything about you, you need to convince them that you're trustworthy, you're honest, and you have the skills that they can count on for you to earn them an income, while all the while mitigating risk. Investing into you should almost be like buying a corporate bond. You're going to be a little riskier, so you're going to have to produce more income, okay? But you need to be able to prove that. So now, by definition, Ellsworth, you probably need a 3-year track record, because it'll show as market conditions changed over those 3 years. You can adjust. If you had a bad month, it didn't stem into 2 or 3 in a row, and you can say, oh, well, remember back when such and such a thing happened, right? The market freaked out. Well, I got out of that market, and that's why that month was a loser, but that's also why the next month was a winner. I had to adjust because market conditions changed, and I had to adjust the strategy. And that's why that was a losing month, but that's why we were followed up by 3, 4, 5 good months in a row. You can explain these things. The markets changed, and therefore we changed. Okay? This is what you need to explain to another human being. Okay? So how long, Ellsworth, so that'll take 3 years. How long will it take for you to increase your skill of technical analysis and fundamental analysis to get to the point where you can start developing the 3-year track record? Okay? 6 months? Okay? Like, I bet you it's more than 6 months. But we'll start with that. So let's just say now, let's say, even if it's a year, let's just say, okay, 1 year to learn, 3 years to produce. So 4 years from now, Ellsworth, if you do your job right, and I mean, look, if you work day and night at this, maybe that's plausible, especially if you have help, right? So now you have a 4-year plan, Ellsworth. 5 years from now, you can think about making a lot of money. Okay? So here's what I would do. I would trade as small as I possibly can until you can prove to yourself that you can make what would be straightforward. Let's say 300 pips every month for 3 months in a row. Okay. Yes, and Kevin brings up a good point. What you want is somewhere between 1, well, let's say 0, something between 0 and 5% per month. If you're producing more than that, you're probably taking on too much risk to attract a sophisticated investor. Okay, so let me wrap up that thought process with one other thing. If your goal is to make a lot of money, you're going to need a lot of money in the account. Don't have this goal of you're dirt poor, but you're going to somehow come out the other end filthy, stinking rich. It's a bit of a dream, okay? The world doesn't typically work, well, it doesn't work. The world doesn't work that way. So what you need to come out of this, Ellsworth, is you need to come out with a legitimate skill that you're worthy of doing for somebody else. Now, it could be a bank. Let's say you just get a job. They pay you $100,000 a year to do your job, which means you probably need to produce somewhere between $300,000 and $500,000 a year just for them to cover all the normal expenses. So you need to be able to say, well, if you hire me for $100,000 a year, I'll come to work every single day. I'll sit down, and at the end of the year, you'll have $500,000. But that's what an investor does too, right? So now instead of trading the bank's money, you decide you want to work with investors, which is good because the more investors you bring in, the larger the pool of money you have to manage. And now instead of making $100,000 a year, you make $100,000 a month. Okay, but you still have to do the same thing. You have to sit down and say, if you invest with me, there's reasonable risk, low drawdowns, low volatility, and an income that you can count on, and that you can do this. And you have to be able to prove it to somebody. And then they add the money, whether it's a bank adding bank capital, or whether it's investors putting money into a managed account program, or you start a hedge fund and then become limited partners or something. But the pool of money that you're managing is the source of the wealth. Your trading should be exactly the same. If you have $1,000 or $1 million, you come to work, you punch a card, you sit down at the pip factory, and you go click. The only thing that changes is the lot size, right? But if your worst month is a negative 2%, it should be a negative 2% on 1,000. It should be a negative 2% on 1 million. The only thing that changed is the assets under management, AUM. So here's the big story here. How do you, what size lot should you be trading? With $1,000, the smallest you possibly can get, because your focus is not on making money. Your focus is trading conservatively, with discipline, with focus. Every trade has a plan. Every plan has a bias. All bias is set by long-term charts or fundamental analysis of macroeconomics and central banking policy. And with that, do that for 25 years, Ellsworth, you'll be filthy stinking rich. money will just be pouring out of the sky in search of you because now you're a hero. You're not selling penny stocks to old people. You're doing the world a favor and making society a better place. Yeah. So, boom. Kevin says, what's a reasonable floating drawdown? Well, in my portfolio management group, if you have a minus 10%, you're going to get a spanking, right? Minus 20, I push you out the window. You lose 20%, there'll be a pile of dead bodies out the window, and you're not coming back. In fact, the account is shut down automatically. You're dead before you know it. It's like a sniper bullet, right? You're negative 19, and you're thinking, I'm down 19%. I think there's a sniper out there. I don't see him, but I can sense him. And then all of a sudden you don't exist. That's how it happens. It's just, you're out, goodbye. Okay. Cool. So there's the target. Boy, we went on today, huh? Sorry guys. Wow, you got me fired up on my unbirthday. It's my unbirthday. I just lost a year. No, it's 45. Yeah. Maybe let me leave you with this one thought. Maybe this week you do watch Bloomberg or CNBC or something like that. Find a way that you can see a real professional investor. Okay? And listen, or we'll see end here. And listen to how they think, how they speak, and they tell you. They're looking at long-term moves. I listened to an interview with a bond trader from PIMCO, and he's like in the short-term trading desk. He's the head of the short-term trading desk for fixed income. So how does he define short-term? Right? This gets interesting, right? 1 to 3 months. This is for the entire firm. He's the head of trading on the short-term desk. 2 to 5 years. Right? You're on the 5-minute chart. And to him, he may not even know you exist. Because he's looking at his weekly chart on the same thing. I don't know. So really, I want to train you not just to be a decent currency trader and stuff. That's easy enough, right? I want to train you to be a professional. I want you to survive at TradersWay, right? I want you to make money. And the first challenge is just to get you to think bigger, right? Think bigger. And then look at your charts from a bigger point of view. I'd say, every day you should ask yourself, what is the plan? What's going to happen next? I wonder what happens when we hit this daily 21, okay? Because if you're a bear, that's a sell, okay? Okay? And if you're losing money in the volatility, meaning something happened over the last hour and a half and you lost money because of it, then take yourself out of the volatility and trade it from a higher time frame. Do things like sell off or buy off the 4 hour 21. Find your sweet spot, guys. Well, and that's the other thing, John, and John's got it. You're going to need a larger stop if you're going to trade on the higher time frames. So therefore, you're going to need to reduce your lot size. Okay? What if, pray tell? Well, how about this? And I'll leave you with this thought. And this was with John, because John was saying, he's trading big lot sizes and stuff. And I don't really care about his account sizing. Let's just talk about sort of right sizing. What do you want your worst month to be on this trade record of success that you're going to show an investor 3 years from now? Over the course of the next 3 years, what do you want your worst month to be, percentage-wise? The worst month, minus 10%, minus 5%. Wesley, you're Cinco de Mayo baby too? Yeah. Right on, Wes. Yeah, what do you want worst? And plan on it, guys. Engineer it. Over the next 3 years, the worst, when everything goes wrong, what percentage is that going to be? Okay? And so now like if you're having that and you're approaching your threshold, maybe you should just stop trading. At the very least, you don't have anything worse than what you want to admit, right? And then the second thing is, how many pips do you want that to be? 200 pips? 500 pips? 1,000 pips? Then you have to reverse engineer the whole thing. Because you want it to be so bad, you're like, I can't lose 1,000 pips. Well, that's where you need to get. Like, well, okay. So John says 3%. So let's just say 1,000% adds up to 3%. Sorry, 1,000 pips adds up to 3% for John. Now you know your lot size. No, not a stop. Your losses for the month. So can you have 10 losing trades in a row with 100 pips each? Okay. Ali says yes. All right. This tells you one thing. Okay? Well, this tells you right away. If your stops are 100 pips, and I mean, look, if you make one trade, let's say the yen pairs today. Let's say I buy all the yen pairs. That's really one trade, if you think about it. Okay? Okay? Because it's just one idea. You're like, you bought all the yen pairs? Well, that's a yen. That's a long trade, okay? But let's say you lost 100 pips, and then you make another trade, and lose 100 pips, make another trade. You're losing 10 times in a row with 100 pip stops? You suck beyond belief. Maybe you need a timeout. Like, what would your mom do? Like, Ali, timeout. Yes, Mom, right? And you need to like evaluate what in the world is going on here. Now, maybe it's a time like this, like, look, I'm a dollar bear. Everyone in this room knows that. The dollar's unbelievably ripper strong. So in a situation like this, I hope I don't lose 1,000 pips. But I can look at it and say, maybe I should moderate my trading, right? That kind of stuff. Because I don't want to be in that situation. But the point is, right? You get that? Is that somewhere along the line, you will have enough information where you need to adjust what you're doing. You want to put yourself in a position where, like John says, 3%, and if 3% was 1,000 pips, and if John is trading properly, that's unthinkable. It's inconceivable. Like flipping a coin heads 10 times in a row. Like, it's possible, but very improbable, right? So that scenario is extremely unlikely. And that's where you want to get. So that your worst case scenario is really when the zombie apocalypse happens and ruin your trading. But you didn't lose more than 3%, right? Because you can recover from 3%. Now, you lost 1,000 pips, you're going to have an ego problem. You're going to have to earn it back. And I've gone through bad periods. Oh, let me tell you, I've gone through bad periods. But I earn them back. Slowly, I rebuild my confidence. Because it's a confidence thing. To lose 1,000 pips and you tried hard not to, you're trading well, as good as you possibly can, and you screw up that bad, whoa, at least it's not a lot of money percentage-wise. You can recover from a 3% loss, right? But you're going to have to build some confidence over time. If you lose 50% of your account, you need to double the account to get back to break even. But if you sucked so bad you lost 50% of the account, with being conservative and disciplined and low leverage, how the heck could you possibly double the account? And even if you did, you only get back to where you were? Like, what's the upside of that? So why don't you just not lose the 50%? You see where I'm coming from? Okay? Well, so the whole thing is, yeah, the 1,900 pips, if it's not, let's say, percentage-wise, a lot of money. I mean, it could be $19 million for you. I know someone that lost more than that in 2 days. And I'm like, dude, you lost 19, it was more, it was like 27 million. I'm like, 27 million bucks? And you're like, yeah? Hey, I got the trade wrong. You're like, oh. No, well, you can, it's not being emotional. I mean, you should be emotional when you're wrong, but you should recognize you're wrong, take the risk off the table, and reevaluate your strategy. So right now, I'm like, dollar strong, partially because the European central banks are talking the dollar up by talking their dollar down. Economic data is not coming out good anymore, so the trend may be changing in the macro. And with these high yields, I get why the dollar's strong. I don't think it's going to last forever, but I need to adjust. In a situation where I'm this wrong, I'm okay being wrong as long as I'm not losing money. Because I'll tell you what, if I'm a dollar bear, the market will go bearish again. Today, tomorrow, next week, next month, next year, next decade, I'll get it right. And when I get it right, I'm going to get it wicked awesome right. Filthy stinking right. And when I'm wrong, time to redo my research. Okay? So I don't know what came of this today. I hope it was valuable. I guess we would call this a psychological session. Sorry, it went long and all that kind of stuff, so I apologize. But Jean-Guy, cool. So I have to now take a 3-hour macroeconomics exam covering everything from managing banks, solo growth models, loanable fund models, mortgage-backed securities, monetary policy, crisis management. It's going to be a long exam. Oh yeah, it's like, it's everything. It's like basically everything about central banking that you can possibly imagine. It's so much information. This class was so much information. It's actually quite amazing. I honestly would like to take the class over again. Hopefully not because I fail it, but it was so fabulously interesting, but it was so unbelievably detailed and complex, and it's literally drinking from a fire hose, right? And, you know, I think you know I know a bit about macroeconomics. And this class is like a butt-kicking class in a sense of just pain and horror. It's so complicated. But the professor is a senior economist at the Fed, and it's Harvard University. It's hard. It's freaking hard. I don't know how these kids can do it. I have 20 years of macroeconomics experience, and it's hard. So anyways, should be an interesting 3 hours, huh? It's like it's 100 questions, I think. Imagine someone sitting down and asking you extremely difficult macroeconomic questions, 100 questions in a row in 3 hours. Just like, wow. But you know what? I have to enjoy it. I'll say, ooh, look at that. Yeah. Yeah. Well, yeah, but I would enjoy it if it was a lot less difficult. Because I tell you, I've taken some of these exams, like the last midterm, I'm like, oh yeah, monetary policy, great. Oh, this is good, and that's good, and this other thing, I'm like really confident. I'm like, wow, I did so much better on this thing, but on this exam versus the first one, because well, you look at me, I am monetary policy. That I am monetary policy. I'm the poster child for monetary policy. Oh, not the result I was expecting. So boy, tough class. So you gotta love the grind. So that's what I'm off to do. Peace on earth. May the pips be with you. May your profits be above average. And I'll see you guys tomorrow. Namaste.